morning. My name is Alexandre Delonchamp, and I'm a press officer for the Banque of Canada. I'll be moderating this morning's press conference. Governor Poloz will be pleased to take questions for about 20 minutes. Before asking a question, would you kindly state your name and affiliation? Please use the wireless microphone that we'll provide you because we're webcasting. If you raise your hand, my colleague will bring the microphone to you on the floor. Please keep it to one question and a quick follow-up to ensure we give everyone a chance. Then we'll see how much time we have left for a second round. The Governor will be happy to answer questions in both official languages. Avant de poser une question, je vous prierai de vous identifier. Je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser vos questions dans la langue officielle de votre choix. Are you ready?
Yes. Thank you for being
So we'll
here.
start with the normal line at the front.
Nirmala Bani from Wall Street Journal.
Right.
Governor, economists gauged a dovish bent to your rate decision last week. I'm just wondering, and today you made mention of the fact that the potential output growth would be higher. I'm wondering if your assessment of growth for second half year from the July MPR was perhaps too optimistic, and do you expect to revise up your forecast of potential growth in October?
Well, I wouldn't want to prejudge that analysis that's ongoing right now for the next monetary policy report. Certainly the story, as I told this morning, is one where we would expect in the due course of time that reconstruction process that we've talked about before will mean a stronger track for potential. But it requires a lot of ingredients to come together, and we don't really have a very good way of judging the timing of such a process. We do see the ingredients coming together, and therefore we would expect it to happen. But frankly, it's almost impossible to forecast it. It's more like by way of an assumption that you make when you first create that.
My second question is more, it's not a follow-up, it's a separate question. I'm just wondering, now that household debt is at a new record and with the expected Fed tapering and higher market rates, isn't there a greater risk that financially strapped households would be caught and increase the threat to the financial system in Canada?
Well, when you speak of risk, arithmetically, perhaps there is an increased risk, but interest rates are extraordinarily low, even if the long-term rates have risen a little bit in this last few weeks. That still leaves them very low, and debt service is quite comfortable in the situation we find ourselves. Looking more down the road, my understanding is that as anybody, as you and I would, and as our bankers would, people are anticipating that over time interest rates will be higher, and so people are doing their arithmetic carefully about what it might be like when they renew their mortgage, if they're a first-time mortgage borrower at this time. So in those conditions, I do think that people understand where they are, they understand what their exposure is, and I'm comfortable that as our forecast unfolds, income will be growing faster than consumer debt, and therefore the ratio that you cite will be declining through time.
We'll go to Greg on the left.
Good morning, Governor. More questions on housing. I noticed the chief executive of Scotiabank said recently, if you were really concerned about a bubble, raise the interest rates. I'm wondering if you can comment on that, because it seems to suggest there are still perhaps significant risks, and secondly, that the Bank of Canada perhaps bears responsibility for cleaning those risks up.
Well, I've said before, and I'll say again, I don't perceive that there's a bubble in Canada's housing market, and therefore it's the if in the statement that you quote, which is very important, and of course means it's a hypothetical question. But the history of this, as you know well, is that we cut interest rates in order to stimulate the economy at a time when there was a very large recession, and one that could have lasted quite a long time. So that was one of the side effects of the offsetting action is that you take on more debt, particularly in the household sector. And housing was a key part of that, filling the gap, if you like, of the downturn. So as we go forward, you obviously have the risk that will go further than you thought was reasonable, et cetera. And I would say we were more concerned about that a year ago, let's say, but things have calmed noticeably. And as I just mentioned, credit itself has slowed, and that's the important thing. So the data points that we get today are from a few months ago, but looking forward, what we're expecting to see is gradual, more building and momentum of income growth, and of course, a slower growth is what we've seen in credit. If that trend is continuing, then that ratio that we pay so much attention to will be declining. So in that context, I continue to say that I think that the situation remains constructive. We certainly don't expect a major disruption in the market, and if we did, that would be counterproductive itself. So it's really a soft landing with the like a tennis ball doing this, I guess is the way I might describe it. So it doesn't necessarily go in a straight line for us.
On investment, you're relying in part, as you mentioned, on animal spirits. So there is perhaps a chance that investment will continue to remain disappointing. Is there a need for a backup plan if investment doesn't come through, either addressing the risks of low interest rates for too long or looking to fiscal policy to fill in the gap in Canadian demand?
So just to go to your premise briefly, what I was suggesting is that the preconditions to stronger investment spending are already in place, and from our discussions with companies, we're feeling the evidence is there, and that's a positive. What we know from our statistical modeling is that in past recoveries, when it starts, when it actually turns, all the modelers underestimate what it then does. So there's a certain switch that goes, and suddenly we're off on a sustainable path. And I called that extra kick animal spirits. So I don't think we're relying on animal spirits. The thing could just go in a more predictable fashion, gradual, perhaps, as companies gather their confidence, as it has been. It could maintain that. But I'm just suggesting don't be surprised when it does kick in, because every other cycle it has done so. And it's those animal spirits that we can't predict. We just don't know when they would come. But as part of that natural growth process, animal spirits are alive and well. They've just been set back quite hard by the experience that we've been through.
We'll go to Nicole on the right.
Nicole Mordaunt from Reuters. The bank said in its rate decision this month that there would be a delay in the shift towards growth led by exports and business rather than by consumer spending and housing. What effect do you think the Fed tapering of its bond purchase program could have on this process? And will it help even if the Fed moves gradually and actual monetary tightening in the US doesn't take place for a long time?
So I don't necessarily see whether the Fed begins to taper or not as an exogenous part of our story, because for the following reason, that if and when the Fed begins to taper, it will be because of growing confidence in the U.S. economic outlook. And that will be a growing confidence which we in turn here will be benefiting from. And so the higher interest rates that may result from, at the long end, let's say, as we saw in recent months, are more of a manifestation. It's very hard to do this technically, so I don't claim that we can explain every decimal point that's happened in there. But it is consistent with that gradual normalization of the U.S. economy, which we're all looking forward to. So since they come together, you don't analyze the interest rate backup as an independent influence on the economy. It comes with its own good news. So in that context then, we see it as fully consistent with our forecast that healing process is underway, and it's only a question of what actually is the speed at which it does so. And none of us really knows that for sure. It's a very judgmental kind of analysis that must be made.
And secondly, I think you've somewhat answered this, but I'm going to ask it in a slightly different way and maybe get a different answer. You suggested in your speech that increased investment will boost the economy's potential growth, and it could therefore take longer for the economy to absorb excess slack. Can you elaborate on how soon you think this will happen and how it affects the outlook for the output gap?
Well, potential output every day requires investment for it to grow. So it's not something that happens all by itself. Companies make new investment decisions every day. And we have to combine with that the labor force growth. Those two things together give Canada its potential economic output. So that's a very complex process. It, of course, relies a great deal on multiple decisions, and it has a lot of uncertainty associated with it from a forecaster's point of view. But what we are suggesting is that when our true process becomes more natural, as I've defined in the speech, that's when it's self-sustaining. And as that occurs, there's a pretty good chance that we'll begin to see, as I mentioned, the replacement of firms that were lost during the recession with new firms, and of course the expansion of firms that remain there today. And that would cause potential output growth to pick up speed relative to what we've been monitoring over the last 2 or 3 years in the wake of the recession. That would be a natural, if you like, a potential output interpretation of what I described before as the reconstruction process. And to put it even more starkly, we know that the output gap, as we define it, is material but smaller than the labor market gap. And that would be because we lost capacity during the downturn. The rebuilding of that capacity would allow us then to see more potential output growth and, of course, taking up more of the slack in the labor market through time. These processes happen quite gradually in my experience, and very hard to actually predict. It'll be more like watching it unfold and updating our assumptions as we go along. A highly judgmental, kind of an analytical process, certainly not a mechanical one. Okay.
I will go to Brent in the center.
Brent Jang from the Globe and Mail.
Right.
One of the favorite topics in Vancouver is always real estate. So
Sure.
You already talked about the soft landing. Could you let us know a bit more how you see that soft landing across Canada and major markets?
Yes, I certainly look at this as a macro concept, which is for Canada as a whole. And our reading of that is that markets have responded to the various changes in the rules around mortgage underwriting in a way which has, in effect, engineered a soft landing, a much more comfortable kind of situation, which has this housing sector, as always, continuing to generate a significant part of our GDP growth. You know, when you look at this in a generational sense, as, you know, even though long-term mortgage rates have backed up a little in recent months, this is very low rates. So if you're in a position to buy a home, of course, chances are you will. So what I've been suggesting, though, is that people take care to do the arithmetic of what it might look like when things renew. You know, if interest rates were, say, a couple of points higher in 3 years' time when you renew, or 5 years' time if you have a 5-year mortgage, I don't know what those numbers would be, but you want to make sure that you've tested it a little bit and that you know you'll be able to afford the payments at those higher levels. But the right now, debt service is quite low as a cost of owning a home.
Do you have another question, Brent? Oh, sorry.
Yeah.
Just wait for the microphone, please.
Yeah. Yeah, David Jan from the Singtel Daily. And as we know, the Chinese economy may be slowed down, and some Chinese buyer probably just out of the real estate market. So do you think that it's going to affect the Canadian real estate?
The Chinese economy indeed has slowed down from what we experienced prior to the crisis, and I think that would make perfect sense to me. I mean, I think that the trend rate of growth in China back, say, in the pre-2008 period was heavily influenced by extraordinarily strong spending growth in the United States economy and indeed certain other economies, so kind of a puffed up growth profile, which now that the U.S. has gone through its crisis and is geared down to what we might say a more normal growth, approaching a more normal growth path, I would expect China to have a lower growth path anyway. But the thing is that today China's growth of say 7% or give or take is not much different in terms of increased demand every day for the world from 10% growth 5 years ago. So that's the way we should look at this. It's an economy which gets bigger every day, and what it demands from the rest of the world keeps getting larger. Even if their growth rate is lower, the increments are still very large. How that feeds through to decisions decisions to buy real estate in Canada, I have no idea. That is a very complicated analysis, and I won't speculate on it. I've certainly talked to a number of people, and I've seen no signs, heard nothing that things like that have slowed down from the point of view of this market. But that's very anecdotal. I have no true analysis to offer you.
So this is the end of the press conference. Thank you for coming.
Thank you very much.